In 2024, MrBeast's videos didn't make money. They lost $80 million, and the company behind them is worth $5 billion. That gap is not a mistake, it's the blueprint. And today, we're going to reverse engineer it. Welcome to NewNewWealth, where we reverse engineer how money is actually made in this economy, not how people say it's made. Here's what almost everyone gets wrong about MrBeast. They think he's a YouTuber with side businesses. The reality is the opposite. Beast Industries is a consumer products holding company that happens to run the most efficient customer acquisition machine ever built. The videos aren't the product. The videos are the advertising. And the advertising runs at a loss, on purpose. By the end of this video, you'll know exactly where every dollar flows, why investors valued a money-losing content operation at $5 billion, and the three parts of this blueprint you can copy at normal human scale. This one is worth saving. You'll want the framework later. First, 60 seconds of context, because the numbers only make sense if you see the flywheel being built. Jimmy Donaldson starts uploading at 13. For 5 years, almost nobody watches. The channel that becomes the biggest on Earth spends half a decade in the wilderness, which matters because the first asset he builds isn't an audience, it's a production obsession. He studies thumbnails, pacing, and retention like a quant studies order flow. 2017. He counts to 100,000. It takes 40 hours. It goes viral. And he discovers the core mechanic of the entire empire. Money on screen is the most reliable attention magnet on the internet. Give away $10,000, get millions of views, sell the views to sponsors, give away more money. Most creators would have taken profits. He reinvested essentially all of it, for years. By June 2026, that flywheel made him the first YouTuber to cross 500 million subscribers. 500 million people. If his subscriber base were a country, it would be the third largest on Earth. But here's the thing, and this is where every How MrBeast Makes Money video gets it wrong. The subscribers were never the business. Beast Industries runs on what I call a loss leader attention engine. Let me draw you the actual org chart of the money. Division 1, Media. The YouTube channels, the branded content. In 2024, it generated about $246 million in revenue and spent $326. That's the famous $80 million loss. A single main channel video can cost $3 to $4 million to produce. AdSense and sponsorships cannot cover that. He knows. It's fine, because media isn't a profit center, it's the top of the funnel. 500 million subscribers acquired at negative cost. Compare that to what a Fortune 500 consumer company pays in marketing to reach the same eyeballs, and the loss starts looking like the cheapest brand-building budget in corporate history. Division 2, Feastables, the chocolate, launched 2022. 33 million in year 1, 96 million in year 2, 250 million in 2024, with 20 million in actual profit, and around $500 million projected for 2025. In 2024, Feastables was the only profitable division at Beast Industries. Read that again. The chocolate bar out-earns the biggest YouTube channel in history. And the strategic choice that made it work, Walmart shelves, not a direct-to-consumer website. Physical distribution, where the margin lives and the audience already shops. Division 3, Licensing and Premium Content, Beast Games, the $100 million Amazon deal. 1,000 contestants, 5 million in prizes, and it became Prime Video's most watched unscripted show ever. 50 million viewers in 25 days. Season 2 premiered January 2026. Notice the model inversion. On YouTube, Jimmy pays to produce attention. With Amazon, Amazon pays him. Same skill, opposite cash flow. Division 4, the expansion layer. Lunchly, the lunch kit joint venture with KSI and Logan Paul going after Lunchables. MrBeast Lab Toys. And since September 2025, Beast Mobile, a phone plan. That one matters more than it looks. It's recurring revenue, the first subscription business in the portfolio. Investors pay premium multiples for exactly that. So the blueprint, in one sentence, lose money making attention, then convert that attention into products people buy every week at Walmart, shows Amazon pays for, and subscriptions that bill monthly. Now the part most videos skip. The actual consolidated numbers and the valuation math. Company-wide revenue, over $400 million in 2024. Projected $899 million for 2025, $1.6 billion for 2026, and management is telling investors $4.78 billion by 2029. Late 2024, Beast Industries raised roughly $300 million in its Series C at about a $5 billion valuation. Jimmy owns a little over half. That, not AdSense, is where the net worth lives. But wait, why would sophisticated investors pay $5 billion for a company that, on a consolidated basis, still loses money? 3 reasons, and they're rational. 1. The growth rate, revenue roughly doubling year over year. 2. The Feastables proof of concept, evidence the audience converts into physical product profit, not just views. 3. The acquisition cost moat. Any competitor entering consumer products has to buy attention at market rate. Beast Industries manufactures it in-house. In investor language, they own their customer acquisition. That's the entire thesis. And it's why his CEO was openly floating an IPO in December 2025. They want the public markets to price that moat. So what do you actually take from this if you're not a 28-year-old with 500 million subscribers? 3 things. Lesson 1, your content is not your product. It's your customer acquisition cost. Most creators try to make the content itself profitable, which caps them at ad rates. The blueprint says, let content run at break-even or a controlled loss, and make the margin on what the audience buys next. You don't need MrBeast's scale for this. A newsletter with 10,000 readers selling one well-priced product runs the identical circuit. Lesson 2. Go where the margin already lives. Feastables didn't win on a website. It won on the shelf at Walmart. Boring, physical, unglamorous distribution. The lesson generalizes, the internet is for building demand. Fulfillment wants to live in proven channels. Lesson 3. Audience converts to equity, not income. Jimmy's salary is irrelevant. His wealth is 50+% of a $5 billion holding company. The end game of attention is ownership. A brand, a company, a cap table. If your plan for an audience is ad revenue, you're renting. The blueprint is about owning. Where does it go from here? The projections say $4.7 billion by 2029. The risks are real. The whole engine still routes through one human being's face. Key man risk that would make any analyst sweat. And consumer product margins are thin enough that one bad launch, like Lunchly's rocky press cycle, dents the story. The IPO question will force the issue. Public markets will either validate the attention moat thesis or reprice it. But either way, the blueprint is already out of the bag, and it works at small scale. Attention converted into owned products, converted into equity. Here's your question. If you had 1 million subscribers tomorrow, what's the product? Chocolate? Software? A phone plan? Answer below. The best business model in the comments gets pinned. Save this video. You'll want the framework when it's your turn. Next episode, OpenAI makes billions and burns more. We'll find out where it actually goes. Subscribe so it finds you.